Thank you very much indeed, Phil. You promised me 5 minutes maximum and failed miserably on that, mate. And I don't know where you got some of that from, but we'll cancel some of the drinks for some of the people afterwards, Ian in particular. Ladies and gentlemen, it's an incredible honour to be able to give this, the first of what I hope is going to be many lectures for the Academy of Real Assets. It's also going to be almost certainly my last lecture, and certainly in this capacity. So I guess it does make it a significant evening. And it's particularly significant for the investment team who have been itching to get rid of me for a long time. But I do have a couple of quiz questions embedded in what I'm going to say, and I'm hoping, true to form, you're not going to lose the opportunity to give us the answers at the end. So tonight is a beginning, it's an end. Alpha and omega, no less. A phrase used to signify significance and completeness, inferring a cyclical nature to existence. Every beginning holds the seed of an eventual end, and every end holds the possibility, threshold of a new beginning. And I'd like to try and explore that cyclicality tonight. I'm going to suggest that a broad understanding of beginnings and ends helps us navigate not only our personal course through life, but also gives us a glimpse of how we might invest for the future in the face of really quite rapid change. My observations are personal, and it's really important that you don't take anything I say as being of welcome, but I would like to add my thanks to Phil's of saying thank you to Wellcome for hosting this evening. Phil has summarised some of my early career, and it's fair to say it was an unconventional course that I had into an investment world. And Phil's talked a bit about that, so I'm thankfully going to skip a certain amount of it, but I'm going to summarise and say I have been phenomenally lucky to have had such an incredible experience and journey. I'm very honoured that my father is here tonight. And truth be told, it's a shock for him to be here tonight because the kids that he had to look after during school days and failed miserably and couldn't become the fourth generation family doctor, sorry, Dad, has managed to stitch a career together at all. And as Phil has explained, I managed to get into the city by hook or by crook, and I did get the sandwiches for the team at lunchtime. But that role gave me an opportunity to see a professional team. And it cemented for me one of the most valuable lessons that I did manage to learn in my youth, which is that you should observe, reflect, revise, and repeat, and repeat, and repeat. And for that, teaching someone to think is a truly great gift. And so let me say, thanks, Dad. So I found myself at Pro, and Phil has already said, one of the great teams, the greatest team of the time. And I'm really honoured that, John, you're here as my ex-boss tonight. I learned so much. It was incredible. Thank you so much. And Pro ended, and my new beginning was Wellcome in 2001. We can ditch that, can't we? Congratulate the team again on a phenomenal investment return over time. I could say a lot, but Phil has summarised it. So let me just say, of course, the real truth was it got me into medicine and a hoped-for family redemption from my family. But to finish as CEO of the investment division was an extraordinary privilege and was not expected, and certainly not by me. And of course, the reality has always been that this has been an incredible team effort. It's been an extraordinary privilege to be part of such a strong team, such a strong culture, mission, and I really want to thank each one of you that has been part of that. I was able to stand on your shoulders, and I can't thank you enough. So if you contributed as you did to those results and to my experience, I'm hugely grateful. And I will say that if I messed up, and I did I'd want to apologise for that. I'm really delighted that this team continues with an internal succession. I want to thank Nick, especially my trusted partner for many years at the back, for being a fantastic partner as CIO. And I have special wishes for Lisha and Fabian, Fabian, as you pick up the baton and take this on as Nick steps away in early 2025. No pressure, guys, just don't, well, you know what. So there have been some pivotal moments which have impacted my life, and I'm just going to share a single one as we tumble into this topic of real assets and the future. I joined Wellcome and I found that my predecessor had just bought a forever property asset, the Time Life building in New Bond Street, just down the road actually from Urban Civics offices. The property industry and the valuers loved the property. Location wonderful, building wonderful, but truth be told, I was quite uncomfortable. And I was watching the price of the tenants' US listed bonds. It was a single tenant building, and I watched them deteriorate dramatically over time, so much so that at one point they were trading at a multiple of just 11. And the property asset, which was the creme de la creme in property circles, was trading at twice that. With support from my CIO, Gary, and I don't know if you're in the room, Gary, I hoped you might make it, but I want to thank him for hiring me. And then an urgent trip to the chairman's private house to go over it one more time, where he talked about being surprised at an analysis from a property person that almost said nothing about the property and said lots about the tenant. He eventually signed it off. We got a fantastic price, 26 times earnings, and the tenant's bonds traded out to 11% or 9 times multiple. And I've got to be honest, I didn't really understand how a market could offer such an extraordinary arbitrage. Bond market on the one hand, property market on the other. But I did know, thankful to Prudential and the training I'd had, which one I trusted. Literally, just a couple of weeks later, the FT ran the headline, GEC Marconi had effectively gone bust. So I got 2 calls that morning, one from the chairman, who was a little bit too generous in what he said to me and said that I actually walked on water. Shouldn't have said that. But the second call was from the purchaser, who wanted to know what I knew and when, and would I join his investment committee. That was a pretty good day. We'd sold a really high-profile property asset based on global sort of macro factors rather than on property factors. And the significance of my prior experience and the importance of looking beyond the immediate property investment landscape was not lost on me then and isn't lost on me now. If having a broad-based understanding of the world was important then, boy, is it now. Global domestic product is the classic measure of how well a country is doing. But if we boil it down, I see it as just a function of how many people are doing things, how efficiently they do them, and whether there's any leverage in the system. Demographics, productivity, and debt. I've found this really helpful. So today, we've got Western GDP very weak indeed because demographics have been weakening terribly since the end of the baby boom generation. And that's quite a big problem because demographics really matter. Population peak spending comes at about the age of 45, you might know. So with that in hindsight, how surprised should we have been that something was going to happen in 2008, which happens to be 45 years from the last of the baby boom generation, 1963, that happens to be me, actually. So that's quite interesting. In the UK, if we take that example, is on a declining trend in productivity. And if you put those 2 metrics together, demographics and productivity, you're really left with governments maintaining a positive GDP simply because they're pumping leverage, debt into the system to make up for the shortfall that is coming from the other 2 inputs. Today, it's only debt that is keeping this system going. Staggering amounts of it, actually. So based on August's numbers, which are the last numbers we've got, the US is adding 1.25 trillion of debt to their balance sheet every 100 days. So my first quiz question, to keep the team awake, if no one else, is if $1 represents 1 second, what is the length of time that $1.25 trillion represents for 100 days? Now, net interest payments as a percentage of GDP are projected to reach their highest level in over 2 centuries. If I wasn't on film, I would have some very rich language indeed for governments that have got us into this state. Ultimately, an economy, its jet, its GDP, its prices, well, they all represent real things, don't they? And we calculate those real things and talk about them and value them in the context of money. So as you work, you earn and you get money and you create things. And so the system or prices should stay in balance. But recently, governments have printed money. Lots more money, but there's nothing added to the system of scale. And so we've got prices going up because of the increase in the money supply with an insufficient number of new goods. So people who own assets get richer as asset prices go up. People who don't own assets get poorer because the things that they have to buy are becoming more expensive all the time. And over time, that system gets distorted and enfeebled, actually, by false money signals. If you own assets, as Wellcome has done, you've done really well. But the markets know the truth. And I can tell you that from 1913, measured against gold, the dollar has fallen 98% in value. In just the last 25 years, well within all of our lifetimes, the euro has lost 90% of its value against gold. As investors, we don't discount our prospective returns, do we, against the falling value of our currency? We've somehow become comfortable seeking a return above what I will call a manipulated level of inflation. That is a level of inflation that doesn't account for increases in asset prices. And I have to say as well, I'm not at all sure about the veracity of the CPI number that we use. I've learned a little bit about how they calculate that, and I'm not that comfortable, but we haven't got time. We're well over time to go into that, all Phil's fault. So I can tell you that for certain that the US is debasing its currency by 10% per annum today. I think that's a really big issue, but I'm not seeing people talking and reading about it. And in the UK today, 10% of government spending is on debt. We're borrowing just to pay the interest bill. So no wonder governments are searching for growth, and do not underestimate the taxes that they will search for as well to correct a pretty unholy mess. In 1929, 10 kilograms of gold was worth $7,000, and it bought the average house in the US at the time. The same 10 kilograms of gold today will more than buy the average house in the US today. It's held its value. Now, in fairness, and very quick for the CIOs in this room, they will say, but the S&P 500's done better. And absolutely it has. It is interesting, though, as this world starts to become more fragile and governments print money, that gold has outperformed the S&P for the last 20 years. I think that's telling us something really important today. So it does surprise me that gold is not seen as an institutional asset class. It's the second largest reserve asset in the world after dollars, ahead of the euro. You might have thought it could form a small part of a diversified institutional portfolio. Russia, interesting question, what you think about Russia. Russia has over 30% of its reserves in gold. My guess is that asset allocators will eventually capitulate, but probably after the horse has bolted. Gold is still a secret weapon, though, for private investors like you and me. I would use it liberally alongside an equity portfolio, but I do just have to point out I'm not allowed to give investment advice. Now, for those that have worked with me, they're probably not that surprised. Wry smile from Nick, who knows I'm a gold bug and have been for a very long time. So let's go for something that might surprise you instead. We've done really well by investing in secular trends early, but rather than I missed the biggest secular trend of the last 15 years, a secular trend that has delivered 140% per annum for 15 years. Today, it's a multi-trillion market. So my second quiz question, if you're still awake, is what would the value today be of a $1 million investment in my missed opportunity? If it's listed as an equity alongside major companies of today, you'd find, as I'm sure you've now guessed, that Bitcoin would only just outside the top 10. Now, that's getting a bit provocative in an audience of professional investors. Cryptocurrencies, I think, are becoming a real thing, and I'm kicking myself, personally and professionally, that I didn't think it through more carefully. I am beginning to understand why, in a fragile financial system such as ours, you might want to hold assets outside of that traditional system. Bitcoin and gold have been two of the very best performing asset classes in the last 20 years, full stop. And basically, institutions haven't held them. They didn't hold UK residential property either, would you believe? And really, it's just this decade that we've seen that come into the asset base. So real kudos to Wellcome for owning it for as long as they have, and all the more so for owning what I think is now undoubtedly the country's leading master planner and developer of residential portfolios. And thank you, team, for being here tonight. Perhaps we shouldn't be too critical. I mean, it's difficult to invest in revolutions, isn't it? Fortunes are made and lost. Let's think of the railways. Some people made a load of money, some people lost a load of money. But is the takeaway not that the world really changed as a result of the railways? And they were the beginning of a new cycle, if you like. I think of assets like gold and Bitcoin now as potential hedges for what I am going to call from now on real world inflation. And I think they might work better than some of our traditional inflation hedges, like, dare I say, as a property professional, property. If we're going to hedge real world inflation, and I judge that there's more to come, and that can be discussed, we must broaden our investment horizons as to what is an exceptional asset class. We may need to incorporate some of society's revolutions far earlier than hitherto one has traditionally done, right? We need to get our position sizing right, but 140% per annum will pay for an awful lot of misjudgments elsewhere if you get some of them right. Real estate is, of course, mindful of my audience that there is so much real estate experience and competence here. I should say something about it is a partial hedge to inflation, well, at least to consumer price inflation. So there does probably remain a place for it in institutional portfolios, at least for the time being. I'm a little bit worried, though, that all this debt in the system has really just effectively maintained the value of our real estate assets, because our earnings and our rents and our dividends, they're typically tracking GDP. So price seems to be following the liquidity cycle, and earnings are following the business cycle, and I think we need to think about that. I'm beginning to wonder if CPI, RPI is indeed the right inflation metric at all for what we do as institutional investors. If we require 4% over CPI, I can see how that's achieved. But if you require 10% over CPI to account for the true debasement of currency, I wonder what you invest in. I think you're left with technology and maybe crypto and certainly growth stocks. So can the so-called real assets of the past really do the job in the future if the future is going to change. I think our traditional definitions may need to shift. The greatest real asset that we have as humans in our world is our world. Much is made of the human impact on this world, and I don't dispute for one moment that humans have made a very significant contribution to global warming. But I've been challenged recently to see global warming in the context of big, very long-term natural cycles. The Gleisberg cycle, for example, the Schwab solar cycle, for example. You see, weather follows cyclical patterns over centuries. These cycles can be predicted through statistical correlations, and there are several key influences which we haven't got time to go through, but current conditions indicate a move into a much more uncertain weather cycle, and we know it, don't we, because we're living through it. You need a PhD to understand this, and I don't have one, but what I think we can say is that when there is an intersection of natural cycles, for example, solar activity or sea temperatures, and human-induced factors, such as deforestation, we set the stage for increased weather volatility. A look at just one of those things or the other does not provide the full picture. It matters to see the whole long-term context. Following a peak in Western civilization property values in 2007 and 2008, and in 1989 and 90, and before that in 1971-72, I'm daring to ask the question, is there a long-term real estate cycle? Fred Harrison's seminal work, The Power in the Land, predicted the collapse in property values in 2008. When was it written? 1993. Having seen this cycle, I'm finding it difficult to not see it anymore, especially when it might be right on plan right now. There is another alternative to that sort of work, let's be honest, and it's one of my favorite stories, and I'll share it because it's the kid standing by a shot-up wall, holding his shotgun, and the sharpshooter comes back and says, "Gee, that's impressive." "Yep," smiled the kid, holding out his hand for $1. Dollar duly delivered by sharpshooter. The sharpshooter asks, "How did you learn to shoot like that at your age?" Dollar now in pocket, kid says, "It's easy. I shot the wall and I drew the targets around the bullet holes." There's a lot to that story, particularly in financial services, I have learned, but I can't deal with it now. There is definitely no certainty that real estate history is going to repeat itself. But if you just accept for a second that it could, and by the way, that would be 2026 if anyone's wondering, might we not ask, would it be sensible to do anything today to get our house in order, just sort of in case? It doesn't mean that we should sell good assets, and it's not a prediction of doom, but perhaps we should financially structure ourselves in such a way that we can't lose that asset to the banks if things get a little tricky. You could also guess that there'll be an amazing opportunity to buy back in again a couple of years later, just as history has offered that opportunity. Don't be surprised, therefore, I might say, if we get a small secondary banking crisis in the US in 2025, 2026. Now, of course, I'm well aware that's putting me at serious odds with the professional real estate commentators of the day, who are saying we're at the beginning of a new cycle as interest rates fall. Ultimately, I might be completely wrong, and they might be, so we shall see. I think that's probably a revolutionary thought for some of you, and I think we should recognize that humans have been through revolutions throughout of history. Stone Age, Iron Age, agricultural, industrial, railways, technology, right through to today. And one of my favorite interviews was Steve Jobs in 1983 at Aspen, when he talked about the rise of the computer in society. Now, whatever you think of Steve Jobs doesn't really matter, probable genius. But what we can see now, 40 years later, he was laughed at for, but he's underestimated the change that we would actually live through. And if we ask what would he make of today, boy, I think he'd blow our socks off with talks of technological revolution. And I think we need to take it very, very seriously. Revolutions are underway, ladies and gentlemen. They don't all come to pass, but one that will was released on us just less than 2 years ago, albeit it had been worked on for many years. And most of us here today haven't got a clue what it's going to mean. And that very much includes me. I think we're going to underestimate the long-term impact of artificial general intelligence. So we need to ask the question how we navigate our investments in the light of these revolutionary changes. And so I think we need a new framework for thinking. I think we need to integrate macroeconomic insights more so than we have done historically. I think we need to understand cycles and understand where we are in those cycles more than we have done. And I think we have to have a view on AI revolution. Oh, and by the way, there's a ton of other revolutions. Energy revolution, do not underestimate, that's coming. Biotechnology, human health, etc. Very exciting. We haven't got time to talk about them now, but we need to build a new investment strategy. I really worry that institutional investors as a group will be slow to adapt to this because they have been slow to adapt before. And I very much hope and trust and don't believe that Wellcome will be slow. We've actually got a real competitive advantage as private individuals because we can do things that are more difficult for institutions to do. So I'd encourage you to think on that. There's a website called Trueflation, which I love because it's full of very objective, tens of thousands of bits of data. Do you want to know what their real asset portfolio is today? They say 25% gold, 25% Standard & Poor's 500 equities, 20% each for WTI oil, and 20% for silver. And that leaves you 10%. And what's that? That's Bitcoin. Now, of course, they're just putting it out there and challenging us. But I think we've got to think about some of these things. And I know in saying that, with property professionals in the room, they might be pretty disappointed by that. Personally, I'm going to say, even as a property professional, I'm not surprised. Commercial real estate is missing for the list, I think for good reason. Location, location, location has worked very well most of a century, but I wonder if we can still rely upon it now in a world that is dynamic, it's job stealing, it's space robbing, and I just wonder whether we need as much space going forward. I don't think we can invest in passive strategies anymore. I think we have to invest, if we're in real estate, we have to invest in creating something new because the something new is going to be worth an awful lot more than that which was created in the past. So I worry about real estate investment trusts, passively owning and renting property. I think you have to be out there building and creating things. And I think that's a valid way of making money. I think that potentially long-dated capital investments to funds, to property, to companies, I worry about it because I worry about locking up that money now in a world that is changing very, very rapidly. And so I think we have to ask the question, are we getting sufficient reward for the long-dated liquidity lockup that we're taking on when we invest in those things? And of course, I realize that artificial intelligence might solve some of the problems of this world, but I'm not sure that it means that we need more space. And if we are going to concentrate on investing in property and space, I much prefer residential. I much prefer creating new residential places where people are going to act in community and they're going to live, work and play. And so I'm pretty pleased to be involved with Urban and Civic, and thank you team for having me. But I'm quite excited about what that could be going forward, because it's the creation of places that has the best future for our profession. I think we need, therefore, a bit of a more dynamic approach. And I worry a lot about the traditional 60-40 portfolio of equities and bonds, because bonds in a higher inflation environment are certificates of confiscation, frankly. Wellcome's played it beautifully by issuing bonds. And when interest rates have fallen a little, I hope to see more issued, because that must be the right answer. Whatever happens, I think equity is the right thing to be invested in, but I can't help wondering whether indices now are a bit safer to invest in than individual direct companies, because there's going to be so much disruption, there are going to be so many winners, there are going to be so many losers, but I'm not sure I know who they're going to be. And I think that survivorship bias for that reason is going to be really important. And you get that from an index, and you don't get it from investing in a direct company stock. Probably the last thing I'm going to predict, if you like, and then we'll wrap up. I do predict that as we get this sort of conflux of computer-led, machine-operated, risk of a dystopian world, if you like, that humans are going to demand a new social contract of some description. I don't think we know what that means, but I think it's bound to involve us needing to take greater account of societal value in our asset values. So asset managers and valuers, please beware. Drinks beckon, and we're over time. That's because Phil was far too long. So in far too little time for me to explain some of what I've been saying, and much too much time for you, I suspect, I've tried to explain the significance and value of teamwork, of experience, of looking beyond the here and now at the big picture. I've tried to explain the importance of seeing the macroeconomic environment for what it is, and the consequence of what I think is real world inflation, and that it's not accounted for in the metrics of today. I've talked of gold. I've even potentially talked of cryptocurrencies as possible hedges to that real world inflation, and I've contrasted the role of real estate in the past and potentially in the future. I've tried to explain the importance of cycles, especially when they overlap or coincide with each other and or human activity. And I offer you the possibility that we might be nearer the peak end of a real estate cycle than the start of a new one. And I'm certainly arguing that the advent of artificial general intelligence with quantum computing and robotics puts us on the very cusp of the next genuine technological revolution. And that will impact all of us. So there are going to be huge implications for society and for investment portfolios too. We can't miss investing in revolutions. The industry misses it. They're too slow. I think it's going to matter a lot that we're sharper, we're more on it than we have been in the past. There's no be-all and end-all truth in investment markets, I've learned. There's often no specified beginning, and there's no clear ending except with the benefit of hindsight. So change is the only constant that we work with, and the consequences of failing to see change are always profound. But tonight, we're in an extraordinary position. We can see change coming, and we might be able to do something about it, and that leaves me really quite excited for the future. There is a natural rhythm to life. It has got a beginning and an end, and the end can offer us a new beginning. I'm not ready to retire just yet, so please don't think I'm going to. Some of the team are a bit scared by that. But I do have time to reflect, observe, and revise my thinking. And I'm going to travel pretty hopefully, because I note that most of my new beginnings have been better than the endings that have preceded them. So I'm hoping that the best is yet to come. And if all this change of talk and revolution is frightening, let me say this. The best mentor I ever had, thank you, Mark, challenged me thus: to successfully chart the course for the future requires us to be a lookout to see what is coming, and to be the captain that makes the decision on the course that we choose. But the best decisions that we will make will be those that come from utilising our full humanity, our inner ability to think, to dream, to fight, and to love. Let me add that artificial intelligence is going to be incredibly transformative, but it will not be human, and it will not love. I'm told that a good presentation can be captured in a single thesis, a single line. So let me try. Wayne Gretzky is possibly the most famous ice hockey player on the planet, and he is credited with the following quote: "I skate to where the puck is going, not where it has been." I think that's what I've taken too long to say tonight. So there you have it. I guess I'm demob happy. I guess I've got time to think. I guess I've got time to play. And do you know what? Tonight, or earlier today, I was told that I needed a party outfit for tonight. Really, Leisha? But if Wayne has got it right, and if you excuse me, I think I might as well just copy him, don't you think? And obviously, as I do so, it's time to say farewell. But the farewell is fare thee well. Thank you all once again. It's been an incredible honour. I hope I'll stay in touch with you all. And please do embrace the changes, don't run from them. My hope for the Academy and for Wellcome and for all of us here is that the best is yet to come. Hasta la vista, baby.
That was an amazing tour de force from Peter. I think we all agree with that. And from the Academy's perspective, what an extraordinary honour, truthfully, to be associated with him, with the Wellcome, and today's event. We've only been going 4 years. Some of our greatest supporters are in this room, of which Phil is one. And Phil and I first started talking about the Academy in probably 2018, 2019, something like that. And he was been a tremendous help and guidance to me. The idea really is a very simple one, and it's one that everyone in this room understands. And it's that there are an awful lot of very disadvantaged places, and a lot of very disadvantaged students in those places up and down this great country of ours. And our business, for want of a better word, real estate, has a unique opportunity because we're one of the very few businesses that can look many of those students in the eye and say, it doesn't really matter if school wasn't your thing. Our business is fortunate in that there is something for everybody. And when we were doing our due diligence on whether it was worth starting the Academy, because there's lots of other fantastic philanthropic activities and entities in the real estate sector, the one reason we thought we had to was because an awful lot of the resource and time goes to a relatively small number of very academically able students, albeit from very disadvantaged backgrounds. And that's great, and they should get everything they deserve. But if we want to have an impact in real scale, we really want to make a difference to our industry and to tens and 20,000 students a year, we need to get to 10, 20, 30,000 students a year. And so we had to come up with a model that was scalable. I'm not going to go into that model now, but I think we sort of proved we have come up with that model. Last year, we got to 3,500 students just in London through 70 events that we ran through our amazing members. We're launching in the Midlands come this November, and we'll try and do the same there. So there's lots I could say. There's a little brochure on your chair. Tonight isn't really about us, it's about Peter and Wellcome and so on. And so thank you once again to Wellcome, thank you to Peter, thank you to Wellcome's organisers, to Michelle and to Vanessa, who isn't here, who's helped organise it. Thank you to my team, two of whom are here today, Louisa and Rianne, who do an amazing job every day getting these events off the ground with these students. And thank you to you for listening. And let's get on with the real business, which is continuing to quiz Peter while we still have him, notwithstanding this appalling pair of pyjamas he's got on. And thank you again for your time and support.
So